Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. Well, in this video, we're going to take a look at a scenario where we're generating $60,000 a year of after-tax income or $5,000 a month at age 60. We're going to look at two scenarios. One scenario is for a single individual. The other scenario is for a couple. We're going to take a look at the assumptions in a second, and we're going to calculate the lump sum dollar amount in total savings you need to have in place just before you hit age 60 to fully fund your retirement aspirations out to age 90. So we'll cover off all the assumptions. Now, if you're new to our channel, make sure you hit subscribe so you don't miss future content. And if you like the video, make sure you click like. Okay, let's look at the major assumptions. We're going to start with the single individual. Now, what's great about these videos when you go through these assumptions is that it gives you a very quick idea as to what you should be aspiring to in terms of savings to reach your retirement goals. In this example, again, it's age 60, $5,000 a month net of taxes for a couple situation and a single. So we'll take a look at the single. Now, we'll go through the assumptions, but the best scenario always is have your own customized retirement income plan done for you so you know exactly what numbers apply to your circumstances. If you go to the show notes, there's a link back to our website where you can find out how to get a complimentary retirement income planning forecast. Okay, so we're going to take a look at Sally. Sally, YouTube. Okay, Sally is going to be retiring at age 60. She'll live to age 90 in this analysis. 3% inflation. We assume government benefits, CPP, OAS will be indexed at 3% for inflation as well. Now, if we go to financial assets, potentially Sally will have some non-registered investments, TFSA account, RSP account. Now, we use different rates of return for the account asset mix. So we'll have cash, fixed income or bonds, and stocks. So the cash investments, we assume would average about 3% per year. A bond portfolio about 3.9% per year, and the stock portfolio 6.54% per year. We assumed each portfolio would have 20% in cash equivalents like GICs, 30% in bonds or bond ETFs, and then 50% in stocks, stock ETFs, individual stocks, stock mutual funds, and they would generate 6.54. Now, using a weighted average return of this mix, 20, 30, 50, each account will generate 5.04% compounded rates of return. Again, just to show you an example, we're using just over 5% returns in the portfolio, and we're going to use 3% inflation, net of inflation returns of just over 2%. So that's conservative, but it's not a guaranteed portfolio, so it gives you a starting point. If you're more of a growth investor, you'll probably need less money to fund your retirement goals. But if you're a balanced investor, this is probably a reasonable place to start for the analysis. Sally does have a residence worth $500,000. We indexed at 2%, but the reality is we never used the real estate asset as part of the overall retirement plan. Now, when we go into the assets, we assume Sally has a TFSA room of $95,000, so theoretically she's never made a contribution, and that she has unused RSP room of $400,000. So when we calculate the lump sum needed the year before retirement, we're going to push as much as we can into the RSP account, as much as we can into the TFSA account as part of the retirement cash flow generation. On government benefits, we have at age 60 a benefit. She's going to have 80% of CPP maximum at age 65 for Sally. Because we have her taking it early, she'll be at 51% of the maximum for a benefit of $8,471 per year. And of course, old age security benefits will be 60 or 85-60. Now, again, this is just an estimate. For your own planning, you might look at deferring CPP until 65, maybe even 70. So there's all kinds of iterations that you can do, but we'll start with age 60 for now for CPP and age 65 for OAS. Again, Sally looked at her benefits on CRA website, and she was at 80% of the maximum. So if she takes it early, she'll be at 51% at age 60 because of the actuarial penalty. Okay, so let's leave those particular sections and take a look at the expenses and the cash flows. So what you see here is the $60,000 per year of after-tax expenses, and we indexed at 3%. So what you see every single year here is that by age 65 for Sally, she's going to need $71,643. And by age 75, she's going to need $96,282. And so every year that expense needs going to go up. Now, we're going to ask the program just to do a quick calculation. Again, age 60, $5,000 a month. How much total capital will Sally need to have in her 59th year to reach her goals? Let's take a look at a quick calculation. Under the Recommendations tab, I'm just going to hit Calculation, and it's going to give us the lump sum number. So it's $1,174,593 is what she needs to have in place when she retires. We're going to apply that number, apply and run, and you can see that the total savings show up in this column here. We've got contributions to the TFSA account, we've got contributions to the RSP account, and we've got money added to her non-registered account. So this $1.174 million got spread between those accounts. When we did that, we'll go to the chart, and you can see that Sally was able to fully fund her retirement. So this is the real estate. It's going up at that 2% every year. By her age 90, theoretically it's worth $942,000 from $500,000. You can see that the RSP account in the blue here is slowly going down, so it's fully depleted by her age 86. You can see that her non-registered account is fully depleted by her age 82. Her TFSA account gets used in earnest going into her late or mid 80s, and it is fully depleted by her age 90. Okay, so that's the first analysis. Again, get your own analysis done. If you're single, age 60 in this scenario, you want $5,000 a month, net of taxes, maybe something different. You can fool around with the assumptions around when do you take CPP, what do you put more pressure on, your RSPs first, your non-registered account, do you leave your TFSAs alone? It's a really good idea to get that sensitivity analysis done for you, but this gives you a basic idea. So just over $1 million. So again, what was the answer? For Sally, as a single, she had to have in her portfolio $1,174,593 at age 60 to fund that lifestyle of $60,000 per year or $5,000 per month net after tax. Okay, so the next analysis we'll take a look at, let's compare that same lifestyle number of $60,000 per year after tax with a couple scenario. Let's take a look at that right now. Okay, now we're going to take a look at Sam and Sally YouTube, and all the assumptions are exactly the same. However, there are some important differences. So the first ones you would automatically think about is both Sam and Sally have government benefits. So the previous scenario, we got one set of government benefits. Now we have Sam and Sally who both have CPP and old age security. So we'll take a look at that, and then we'll look at their investment assets as well. Now, under their investments, I assume that both of them had $95,000 worth of TFSA room. Remember, for the solo situation, we had $400,000 of RSP room, so I've just cut that in half. $200,000 of RSP carry forward for Sam, and we're going to have for Sally $200,000 worth of RSP carry forward as well. If we go to government benefits, I'll just go through each of them. So again, exactly the same assumptions that we had for the last analysis. Sally's at $84.71 at age 60 for CPP, 51% of the CPP maximum at age 65, and plus Sally is going to have her old age security benefits. If I go to Sam, again, we've got Sam's $84.71 at age 60 for CPP, 51.2% of the CPP maximum if he takes it early, and so those key assumptions are in there as well. The expense numbers we kept exactly the same. We used $60,000 per year in after-tax expenses, and we'll go to the actual analysis. Everything else is the same. There's the $60,000. We'll look at a combined $60,000, and so you know the huge difference, and this is kind of punitive, right, to singles, is two can live more cheaply than one. Now we've got extra income plus one household for two people. And so not only do they have the advantage now of two TFSA rooms plus the RSP room, which we assume was the same as Sally living solo, let's take a look at the recommendations tab. I'm going to go to that tab. Remember, it's $1,174,000 for a solo situation. Let's do the calculation. And what you see here is the calculation is quite a bit different. So if we go to the calculation, it's giving us $724,679. Let's apply that. And so that's going to be applied to the calculations. And if I go to Sam and Sally, I won't go through the details. What it does is the program goes through and takes the savings of $362,340 times 2 is the over $700,000 in total they had to save. And that number gets distributed between TFSAs and RSP accounts. You can see that they've got $200,000 in RSPs, added $95,000 in TFSA, a little bit of open money, $67,340, and that is exactly the same for both of them. I go back to the recommendations tab. Again, the total dollar amount that we needed was just over $700,000. Okay, there you have it. So when Sally retired solo, she needed $1,174,000. If Sally retired with Sam, using all the same assumptions, but now we've got some extra government benefits. Sam and Sally needed $724,000. So it's a difference of $450,000 in required savings. Anyway, that's the power of these financial forecasts. It gives you a basic idea of how much capital you need. Obviously, these are rough estimates. I'd encourage you to get your own analysis. Sit down with your financial advisor. If you don't have one, make sure you go to our show notes. There's links back to our website. You can find out how you can get a complimentary analysis. If you haven't subscribed yet to our channel, make sure you do that. And if you like the video, make sure you click like. Anyway, wishing you all the best in your retirement and overall wealth planning journey. You take care. Bye-bye.